last quarter, the average publicly traded Bitcoin mining company spent roughly $80,000, actually, just under that, in electricity and hardware to produce a single Bitcoin.
Right.
But today, a single Bitcoin is only trading around $66,000. So the math is completely broken.
It really is. It doesn't make any sense on paper.
Exactly. But instead of just shutting down, those massive power-hungry server farms are quietly being rewired, like they're being repurposed to power the next generation of artificial intelligence.
Yeah, the pivot is huge.
We're going to unpack exactly how that is happening today. So welcome back to another deep dive.
It is great to be here. I mean, we are looking at a truly chaotic week of news where every single domino just seems to be knocking into the next.
Yeah, and our mission for you today is to connect those dots. We've pulled insights from this massive stack of financial and tech reports, updates from CNBC, Reuters, CoinDesk, and various startup and biotech trackers. We're looking at how global geopolitics, traditional Wall Street markets, the crypto ecosystem, and the AI boom are all just violently colliding.
And before we dive in, we really need to be incredibly clear with you about the nature of these sources.
Absolutely.
Because the events we're analyzing today are, well, heavily politically charged.
Right. Our sources cover the escalating U.S.-Israel-Iran war, President Trump's latest military and policy actions, and even regulatory shifts, like Canada's new election laws.
Yeah.
So to be completely transparent here, our goal is not to endorse any political viewpoint. We are going to impartially report the facts exactly as they are presented in these sources, purely to help you understand their massive impact on the global markets.
Exactly. We're just looking at the market impact.
Okay, let's unpack this, starting with the geopolitical oil shock that is currently setting the markets on fire.
Yeah, so the situation in the Middle East has escalated significantly. Yemen's Houthis have now fired missiles at Israel, which opens up a completely new front in this conflict.
Right.
But the underlying panic driving the global markets right now is this physical chokehold on global shipping lanes.
Which is terrifying for the supply chain, because the Strait of Hormuz is already effectively closed off. And just with the sheer scale of that into perspective for you, about 20% of the world's global oil supply usually passes through that single 100-mile stretch of water.
That's a massive bottleneck.
It is. And now Iran is threatening to block a second critical choke point, the Bab el-Mandeb Strait.
Right. And the global economy relies on a very delicate, highly optimized supply chain. Like, when you threaten to trap 20% of the world's energy supply, the market reaction is immediate.
And severe.
Extremely severe. We saw Brent crude spike to $112.57 a barrel, and U.S. West Texas Intermediate jumped to $99.64.
Oh, wow. And the domino effect on Wall Street from that was just brutal. I mean, the Dow tumbled 793 points.
Right into correction territory.
Yeah, straight into it. And the S&P 500 just marked its fifth straight losing week. Plus, you have Moody's AI-driven recession model hitting a 49% probability.
Which is a huge red flag.
Exactly, because historically, whenever that model crosses the 50% mark, a recession has followed within a year. Well, wait, I'm looking at the timeline and the sources here, and something doesn't add up for me.
Okay, what is it?
Well, the U.S. released 400 million barrels of oil from its strategic reserves, right?
Yes, they did.
And on top of that, President Trump delayed planned attacks on Iranian energy plants, pushing the deadline out to April 6, specifically to calm the markets. So with all that extra oil flooding the market and a pause in military strikes, by all logic, prices should be cooling off. Why is Wall Street still panicking?
Well, what's fascinating here is the massive disconnect between paper oil prices and physical oil prices.
Okay, explain that.
To understand Wall Street's panic, you really have to separate the two. Paper prices are, the futures contracts traded on computer screens.
Right.
And those prices are highly sensitive to headlines. So when political leaders use jawboning, like extending deadlines or floating the idea of negotiations, the paper prices might temporarily dip because traders are pricing in the hope of a peaceful resolution.
But paper contracts don't fuel cargo ships or heat homes.
Exactly, they don't. And that is where the physical oil market comes in. The physical price is the actual cost of taking delivery of a barrel of crude today.
Like physically holding it.
Right. And if we look at Dubai, which tracks physical delivery from Middle Eastern sellers, the physical price is up 76%.
Wow. 70%.
Yeah, you can think of paper oil kind of like checking the Zestimate on a house. It fluctuates every day based on interest rate news or economic forecasts, but no actual money is changing hands.
Right.
Physical oil, on the other hand, is a bidding war for the only livable house left in town because your family is standing on the curb with all your bags and you need to move in tonight.
So the buyers in Asia and Europe, they know that the 400 million barrels from the U.S. reserve is just a temporary measure.
Exactly. Analysts are pointing out that those stopgap measures expire by mid-April. If those straits aren't open by then, the global economy hits an absolute supply cliff.
Oh, man.
And the bond market is already pricing this in. Inflation fears, driven entirely by these physical supply shortages, are driving the 10-year Treasury yield up to 4.4%.
And that 4.4% Treasury yield isn't just a number on a screen, you know? It operates like this massive gravitational pull on the rest of the economy.
It really does.
Like when the U.S. government guarantees you a 4.4% return just for handing them your cash, which is considered a risk-free investment, the hurdle for investing in risky stocks goes way up.
Right, the math changes entirely.
So institutional money gets vacuumed out of equities, which is the mechanical trigger for that massive Wall Street sell-off we just talked about. And the very first thing that gravitational pull yanks money out of is the highest risk asset class, crypto.
Oh, absolutely. It has been a historically brutal week for digital assets. I mean, investors are frantically liquidating their portfolios.
The numbers in the reporting are just stark. Bitcoin dropped down to $66,000. Ethereum broke below $2,000. Solana is down an agonizing 72% from its recent highs.
Yeah.
And the Crypto Fear and Greed Index is currently sitting at a 9, which is literally classified as extreme fear.
Well, a massive catalyst for that drop wasn't just human panic, but mechanical liquidations in the derivatives market.
Right, the automated stuff.
Yeah. We saw a $14.16 billion options expiry on the Deribit exchange.
Okay, let's break down the mechanics of that for a second, because $14 billion expiring all at once is staggering.
It is. So in the options market, traders borrow money to place highly leveraged bets on where the price of an asset like Bitcoin will go. The exchange requires them to put up collateral, usually Bitcoin itself, to secure that borrowed money. If the price of Bitcoin drops below a certain threshold, the exchange's algorithms automatically sell the trader's collateral to ensure the debt is paid off.
Right, so it's an automated margin call.
Yes, exactly. When those $14 billion in options expired, the market was already dipping due to the macro environment and that oil shock we mentioned.
Okay.
That initial dip triggered the first wave of automated sell-offs. But when the exchange automatically dumps all that Bitcoin onto the open market, it forces the price down even further.
Which triggers more selling.
Right. That newly lowered price triggers the next wave of automated margin calls for a different group of traders. It creates a mechanical liquidation cascade.
Wow.
Over 122,000 traders were wiped out, resulting in $451 million in forced liquidations in a single day.
But wait, I have to challenge the foundational narrative of the crypto industry here for a minute.
Sure.
Because for years, the rallying cry has been that Bitcoin is a safe haven. Like, it's pitched as digital gold, right?
Right.
A hedge against inflation and the traditional financial system.
Right, that's the marketing.
So if inflation is spiking because of an oil shock,
Yeah.
why is digital gold tanking right alongside the S&P 500?
Well, it really comes down to the macro reality of how institutional money operates today. Crypto is no longer just retail traders operating outside the system. It is heavily institutionalized.
Okay, so the big players are involved.
Exactly. When inflation fears rise, the Federal Reserve is forced to keep interest rates high to cool the economy. High interest rates strengthen the U.S. dollar. When you have a strong dollar and a risk-free Treasury bond yielding 4.4%, portfolio managers are mathematically compelled to reduce their exposure to volatile assets. So despite all that digital gold marketing, big money still treats Bitcoin as a high beta tech stock.
That makes total sense. And add to that the regulatory headwinds we are seeing in the sources. Like, Canada just moved to ban crypto donations for election campaigns, which follows a similar move in the UK.
Yeah, the walls are closing in a bit.
So you have a tightening macroeconomic environment and tightening regulations hitting the market at the exact same time. But the sources also highlight some really interesting bright spots underneath all that panic.
They do. If you are watching this market, you have to look closely at Tron, the TRX token. It is actually outperforming the broader market right now.
Right, and the mechanism driving Tron's performance is entirely based on stablecoins. For those tracking, Stablecoins are cryptocurrencies pegged directly to the US dollar. And Tron is currently facilitating massive volumes of stablecoin payments, particularly surging in Southeast Asia.
Yeah, they are essentially becoming invisible everyday payment rails for ordinary commerce there.
Exactly.
And the total supply of those stablecoins across the entire crypto ecosystem is sitting at a record $316 billion.
Yeah.
Wow. 316 billion.
Right. That specific number is the key to understanding the psychology of the current crash.
How so?
Well, when you see Bitcoin drop from 70,000 to 66,000, the assumption is that all that capital just evaporated or exited the crypto ecosystem entirely.
Oh, I see. But a $316 billion stablecoin supply tells a totally different story.
Exactly. Capital hasn't actually left the building. It's just stepped off the dance floor.
I like that analogy.
Yeah, institutional investors and traders are selling their volatile Bitcoin and Ethereum, but instead of cashing out to traditional bank accounts, they are parking that value in digital dollars on the blockchain.
Keeping their powder dry.
Right. They are waiting for the macroeconomic conditions to stabilize. However, while that specific capital is sitting on the sidelines, another massive chunk of the crypto industry is actively abandoning ship to chase a completely different gold rush.
Yes.
And this proves just how physically demanding the artificial intelligence boom has really become.
This is where the underlying infrastructure of the global economy is just shifting beneath our feet. We're talking about Bitcoin miners pivoting to AI. Earlier, we laid out the math. Last quarter, the average publicly traded Bitcoin mining company spent roughly $80,000 to produce a single Bitcoin. With Bitcoin trading under 70,000, it costs more to manufacture the product than the product is worth.
The math is brutal.
So these massive mining operations are liquidating their Bitcoin treasuries just to stay afloat. But they aren't just closing their doors. They are pivoting their core business models to artificial intelligence, taking on a massive $70 billion in AI contracts.
Right. And if we connect this to the bigger picture, it tells us something profound about the modern economy. Compute power, the actual physical hardware and electricity required to process data, is the new global commodity.
Here's where it gets really interesting. It's like a gold miner realizing that the heavy machinery they own is actually way more profitable for building a brand new city than it is for digging up more gold.
That's exactly what's happening. Think about the infrastructure required to mine crypto at an industrial scale. You aren't just plugging a computer into a wall.
Right, you're building massive warehouses.
Yeah. You are securing contracts for gigawatts of cheap industrial electricity. You are installing highly sophisticated liquid cooling systems to keep tens of thousands of processors from literally melting down.
So that exact physical footprint, the power grids, the cooling, the industrial zoning, is the precise infrastructure required to train large language models for AI.
It's a perfect match.
So AI is so incredibly capital intensive, so hungry for raw power and hardware, that it is literally absorbing the physical resources of other tech sectors to fuel its own growth. The AI boom is physically eating the crypto mining industry.
Which seamlessly connects to the broader corporate world.
Oh, absolutely.
Because it is not just crypto miners throwing billions at AI infrastructure. While the traditional stock markets are terrified of a geopolitical oil shock and a looming recession, the world's biggest corporations are doubling down on artificial intelligence.
Yes. To the tune of tens of billions of dollars.
Yeah.
They are completely defying the macro gloom.
Totally ignoring it.
Let's run through the mechanisms of these massive corporate bets. So SoftBank, the massive tech investment firm, they just raised a $40 billion short-term loan specifically to back its growing exposure to OpenAI.
Right.
And analysts are noting that raising $40 billion in a high interest rate environment signals major confidence in a possible OpenAI IPO.
I mean, $40 billion is a generational bet. You don't take on that kind of debt if you are worried about short-term market volatility.
No, you definitely don't. And the investment is extending far beyond Silicon Valley tech firms, too.
Oh, yeah. Look at pharma.
Exactly.
Yeah.
Pharma giant Eli Lilly just signed a $2.75 billion deal, and that includes $115 million up front with a Hong Kong-listed company called Insilico Medicine. The goal there is to commercialize AI-developed drugs globally.
And Insilico isn't pitching a theoretical concept here. The data shows they have already developed 28 drugs using generative AI, with nearly half of those already in human clinical trials.
Wow. And to understand why a pharmaceutical giant would spend nearly $3 billion on this, you really have to look at how generative AI physically alters the lab process.
Right.
Because a traditional pharmaceutical lab operates in the physical world. Scientists manually synthesize thousands of chemical compounds, put them in petri dishes, observe the reactions, and eventually move to extensive animal testing.
Which takes forever.
It's a decade of physical trial and error that costs billions of dollars.
Hmm.
But generative AI moves that entire initial process into a digital simulation.
Exactly. The AI can digitally screen millions of molecular combinations in a server, predicting how different compounds will bind to specific disease receptors before a single glass beaker is even touched.
That's incredible.
By synthesizing molecules digitally, they bypass years of physical testing. They drastically reduce the need for animal testing. They basically shave years off the development timeline.
And Insilico's geopolitical footprint is just as fascinating as its technology. Like, the CEO explicitly stated they developed their AI models outside of China, utilizing talent and infrastructure in places like Canada and the Middle East.
Mm-hmm.
Then they conduct their early preclinical drug trials inside China. And finally, they partner with Eli Lilly, a massive U.S. corporation, to distribute the drug to the global market.
It perfectly illustrates how AI is creating entirely new, complex, globalized supply chains.
Yeah.
And those supply chains are increasingly facing local pushback. Countries are realizing the power of this technology and they want control over it.
We definitely saw that in the headlines with India's Sarvam AI launching a model called Chanakya. It's specifically designed for secure government deployments. Nations want sovereign AI that operates within their own borders and aligns with their own regulations.
Right.
Conversely, you have Elon Musk's AI, Grok, facing severe regulatory setbacks and legal restrictions in the European Union over the misuse of AI-generated imagery.
The friction between borderless technology and bordered regulations is only going to intensify.
But, let me ground this conversation back in the reality of the broader economy for a second.
Okay, sure.
Because we started this deep dive talking about Moody's AI model predicting a 49% chance of a global recession. We have an oil shock threatening the physical supply chain and driving up treasury yields.
Yeah, the macro picture is grim.
So how on earth can a company justify dropping $40 billion, or $2.75 billion, on artificial intelligence right now? If the consumer economy contracts, isn't this just a massive speculative bubble ignoring reality?
Well, it absolutely looks like a bubble if you view AI as a speculative luxury or just a simple consumer product.
Okay.
But the corporations making these multi-billion-dollar bets, they don't see it that way. They view AI as a deflationary survival tool.
Deflationary meaning it actively lowers the cost of production.
Exactly. Let's look back at the Eli Lilly deal. In a recession, consumer spending drops, which means corporate revenues drop. When revenues drop, your only path to corporate survival is drastically lowering your long-term operational costs.
I see. So if Insilico's AI can cut 5 years and $1 billion in physical lab overhead out of the drug discovery process,
Yeah.
that isn't a luxury. That is margin protection.
Right. These companies aren't investing in AI to show off a shiny new toy to shareholders. They're investing in it to protect their profit margins against the very economic storms we were just talking about.
That makes a lot of sense.
Even if a recession hits, they mathematically have to make this investment to remain competitive.
So bringing this all together for you, the listener, what we are watching play out across these sources is a massive real-time stress test of the global system.
It really is.
You have geopolitics in the Middle East threatening to choke off the physical supply of oil. That physical shortage is driving up inflation fears and treasury yields, which is sucking capital out of the stock market and wiping out highly leveraged crypto traders through cascading margin calls. The old economy energy pipelines and traditional finance is incredibly vulnerable right now.
But underneath that macro chaos, the underlying technological shift toward artificial intelligence is actively accelerating.
Yeah, it's speeding up.
It is being fueled by SoftBank billions, by pharmaceutical giants trying to survive a potential recession, and literally by the repurposed hardware of Bitcoin miners who realize that training language models is a more profitable use of their electricity.
It's the destruction of old capital models and the creation of new ones, happening simultaneously across the globe. But before we wrap up today's deep dive, I want to circle back to something we mentioned at the very beginning, because it's the kind of detail that is going to keep me up at night.
Oh, the Moody's AI model.
Exactly. This raises an important question. Moody's artificial intelligence model is currently predicting a 49% chance of a recession. It is constantly crunching all of this macro data, the soaring physical oil prices, the labor numbers, the inflation rates, the bond yields.
Right. And 49% is just a hair away from the historical 50% tipping point where a recession becomes highly probable.
But think about the market mechanics we just spent the last 20 minutes describing. Wall Street is increasingly driven by algorithms. As more and more banks, hedge funds, automated trading bots, and massive corporations rely on these exact same AI models to make their financial decisions. What happens when the AI crosses that 50% threshold and explicitly predicts a crash?
Do all the human portfolio managers and the automated trading bots see that prediction and execute their sell orders at the exact same millisecond?
Does the AI's prediction of a recession trigger the automated sell-offs that actually cause the recession? It becomes a massive, algorithmically driven, self-fulfilling prophecy.
That is the ultimate paradox of where this technology is heading. Is the artificial intelligence just passively predicting the economy? Or, because so much global capital is tied directly to its outputs, is the AI starting to dictate the economy?
That is the question we are going to leave you to mull over today. Thank you so much for joining us for this deep dive. In a week where the headlines are dominated by geopolitical conflicts, oil spikes, and market liquidations, we encourage you to keep looking beneath the surface, keep connecting the dots on how these mechanisms actually work, and always keep questioning the headlines. We'll catch you next time.